You're listening to AM Now, an Accounting Matters podcast. I'm Adam Olsen.
And I'm Nicole Harger.
We've got several stories to touch on today, so let's begin. Kicking us off, we'll start with the recent rule from the Federal Trade Commission essentially banning the use of non-compete agreements in nearly all instances. In fact, this rule is estimated to impact 1 in 5 workers or nearly 30 million employees in the U.S. While there's an argument that non-competes allow a company to guard trade secrets and their employees, the Commission argued in issuing their rule that non-competes suppress the freedom of workers and keep wages low, and also limits the innovation and competition in the marketplace.
With this new rule, employers will need to notify their employees that their existing non-competes will become null upon the rule's effective date, which will be 120 days after publication in the Federal Register, which falls on September 4th of this year. Existing non-competes for senior executives can remain enforceable, especially if they were a negotiated agreement. However, an employer may not enter into or enforce new non-competes. The threshold for a senior executive is an employee that is involved in policy-making decisions and earns more than roughly $150,000 annually. The FTC is still allowing NDAs in order to retain company trade secrets while protecting the freedom of workers.
With that said, this decision will also have potential accounting impacts to those reporting entities that have intangible assets for non-compete agreements on their balance sheets. For instance, companies with these intangible assets recorded may need to revise their estimates on the useful lives and the subsequent amount of amortization for those assets in light of this ruling and expected effective date.
Moving along, last week, the FASB met to continue discussing the proposed ASU for disaggregating income statement expenses. As it relates to joint venture and cost sharing or cost reimbursement arrangements, the board will provide an option to either disclose an aggregate reimbursement amount or map the reimbursement amount to the required expense categories. Specifically, on disaggregating costs of products sold, purchases of inventory is now a required expense category rather than inventory and manufacturing expense. There will be no practical expedience for industry-specific guidance.
The board also spent time further discussing its ongoing post-implementation reviews of the new revenue standard, ASC 606. As part of those discussions, though, no decisions were made, but the board confirmed it will continue to monitor implementation issues and feedback of the standard. Finally, the board wrapped its meeting discussing feedback received on FASB Concept Statement Number 8, Chapter 6 on financial statement measurement. As part of that discussion, the board affirmed several key decisions on financial measurement, including that measurement should be anchored in the entry and exit prices for transactions and events. Only the entry and exit price systems provide accurate measurements for general financial reporting. Reported asset values should not exceed recoverable amounts, and liabilities should reflect settlable amounts. The choice between entry and exit price systems should consider the specific asset or liability and its usage or settlement. And lastly, that financial reporting should clearly distinguish between unique and non-unique prices. Additionally, FASB Concept Statements Number 7 on using cash flow information and present value will be superseded as well. Next steps here is for the FASB staff to draft the final Chapter 6 on measurement of Concept Statements Number 8 for vote by written ballot.
Also last week, albeit on the international standard setting front, the IASB issued another new accounting standard, IFRS 19, which allows eligible subsidiaries to provide reduced disclosures when applying IFRS in their separate financial statements. Subsidiaries are eligible to apply IFRS 19 if they do not have public accountability and if their parent company applies IFRS in the consolidated financial statements. A subsidiary does not have public accountability if it does not have equities or debt listed on a stock exchange and does not hold assets in a fiduciary capacity for a broad group of outsiders.
Historically, subsidiaries have been permitted to use IFRS for SMEs accounting standard, which allowed for simplifications from full IFRS standards, but this would have required maintenance of 2 sets of accounting records. And the alternative of complying with full IFRS standards has resulted in providing more disclosures than are necessary. IFRS 19 is expected to simplify reporting systems and processes for companies, reducing the cost of preparing eligible subsidiaries' financial statements while still maintaining the usefulness of those statements for their users. The new standard is effective for reporting periods beginning on or after January 1st of 2027, with earlier application permitted.
Turning to the SEC, the Commission recently took action against audit firm BF Borgers for deliberately and systematically failing to meet PCAOB audit and review standards, resulting in an order that denies the firm from appearing or practicing before the Commission. The SEC advises issuers who had engaged BF Borgers for audit or review services to promptly file Form 8K Item 4.1 within 4 days of the firm's resignation or dismissal and engage a new qualified PCAOB registered public accountant for any Exchange Act filings going forward.
Not good news there. And for example, any 10K or Q filings after the date of the order may not include any audit reports or reviews performed by BF Borgers. This includes each period presented in the filings. Exchange Act reports filed before the date of the order are not required to be amended solely because of the order. However, amendments may be needed to address the reporting deficiencies from BF Borgers' engagement. The SEC emphasized compliance and reporting obligations and offers guidance to affected companies, urging them to reach out to the Division of Corporate Finance and the Division of the Chief Accountant for assistance on the matters.
And closing us out this week in international sustainability news, the IFRS Foundation's ISSB added 2 new research projects to its list of priorities. Like they're not busy enough, you know?
Mm-mm.
The first project considers risks and opportunities associated with biodiversity, ecosystems, and ecosystem services. And the second considers risks and opportunities over human capital. These research projects will focus on how to build on currently existing frameworks and interoperability with other widely used frameworks.
Yeah, the ISSB will primarily focus on supporting the implementation of IFRS S1 and IFRS S2, with these 2 research projects having a slightly lower focus. As you may recall, IFRS S1 is effective for reporting periods beginning on or after January 1st of this year and introduces sustainability-related disclosures. IFRS S2 is also effective for reporting periods this year and focuses on climate-related disclosures. Jurisdictional adoption of IFRS S1 and S2 is currently underway around the globe. And that rounds us out for this week. For a deeper dive into what's trending in accounting, finance, and sustainability reporting, check out our other podcasts on the Accounting Matters feed on your preferred listening platform. And before we wrap, if you're wanting to unlock the future of your business decision-making skills, take a look at Embark's CFO Guide to Implementing a Rolling Forecast. Discover how to transform your financial planning from a static shore into a dynamic advantage. Our comprehensive guide provides step-by-step instructions on creating a rolling forecast that adapts to market shifts and your operational changes, ensuring your strategies are always aligned with the latest data. From setting clear objectives and identifying key metrics to choosing the right technology and training for your team, we cover everything you need to keep your business agile and informed. Dive into our guide and start forecasting with precision. A link to the guide is included in the show notes. Again, I'm Adam Olsen.
And I'm Nicole Harger.
From your friends at Embark, thanks for listening to AM Now. Stay happy, and we'll catch you next time.